My fellow investors in REITs, real estate investment trusts, 4 days left before the month is out. 4 days left before this quarter, first quarter of 2023 is out. What kind of news, what kind of reality do I have in real estate investment trusts to share with you? Four REITs, Lippo Malls, Prime REIT, Easy World REIT, and Manulife. What is the commonality of all these four REITs? 4 days before the month is out, 4 days before the quarter is out. These four REITs, Lippo Malls, Prime REIT, Easy World REIT, and Manulife. I ask again, what is the commonality? The commonality is that you'll be thinking, oh my God, if you have been shareholders of these four REITs, you would be really heartbroken because in just one quarter, 4 days left before this quarter, you could have lost close to 30% or 30% or more in this real estate investment trust. Take a look. As of yesterday's price, Lippo Malls is down 47%. Prime REIT at 48 and at 31 cents yesterday was down 36% for the quarter. It's the second worst performing REIT. The third worst performing REIT is Easy World REIT, which collapsed 31% in this quarter. And Manulife is almost down or collapsed 30% in just 3 months. So, ladies and gentlemen, what have we got? As we end the quarter, and if you are investors of these four REITs, I sympathize with you. But if you have been attending our classes and reading our book, Making Your Millions in Real Estate Investment Trust, you'll notice that we have mentioned all the stocks to avoid since my book was written 4 years ago on these four REITs. And guess what? Generally, when REITs do not perform, difficult for it to make a U-turn, difficult, for it to actually recover back to original levels. Let me bring through with you essentially what lies ahead. Now, in the last couple of days, we have seen the worst of the banking scenario in the US. So essentially what we have as of last night is that First Citizens have actually acquired certain parts of Silicon Valley Bank, which have gone collapse. So the run on First Republic also is nearing an end or probably have ended. So first in line, and you can see that there are some turning points. In Europe, Credit Suisse has been rescued. You see Deutsche Bank, which got hammered, is already rebounding. So these are positive news. Now look at the 10-year bond yield. Bond yield has actually fallen 3.9%, down to 3.4%, 50 basis points erosion in a very short period of time of 1 week. What about the 2-year bond yield? The 2-year bond yield has fallen from 5% down to below or close to about 4.1%. And so yesterday it was actually down 3.1%. Optimistic things if you are real estate investment trust investors. But if you are shareholders of this 4 REITs, or as a matter of fact, this 10 REITs that has not performed well in the first quarter of this month, you said that includes, other than the 4 REITs I've mentioned, Digital Core, Capital Oat, Elite Commercial, Daiwa House, and Cassia REIT. You notice that essentially you would be hard put to really wanting to be optimistic. You could possibly be missing, the silver lining finally. Okay, now I can sympathize with you, because as individual investors, you are affected mentally, physically, psychologically, and physiologically when your shares portfolio are down, more so when REITs are supposed to be defensive. So what lies ahead? Okay, now first and foremost, one of the key things that we have been, and the tenets that we'll be teaching all this while is this, a REIT is as good as the assets that they have, and a REIT is as good as the sponsor that they have. Now, essentially, for example, take the very first one. This is a chart of Easy World REIT, one of the stocks they've been warning since 5 years ago, as I've written in my book, is the share price has collapsed in the last 3 years from 80 cents down to 30 cents yesterday. And that means it's crashed 63% in the last 1 year. What has happened? The sponsor have added instability or is indecision to actually help to refinance the assets have actually added to greater uncertainty. And you can see this quarter alone, after falling by as much as 50% in this quarter, it continues to fall. When will it stop? Will it even stop? Interesting, right? Big cents down to 21 cents. That is a crash of 70% in the last 3 years. Now, in my book, again, Making Your Millions in REITs, I have actually enumerated and clearly explained that it is actually quite disconcerting, that during the episode of the pandemic, the management have attributed some of the huge fall in the share prices to any other reasons other than their management capability. Interesting, right? Because we have further evidence, and as of the last day of the last year, see what the management actually dish out that shock investors to the core. All right. Yes, you will see this is an announcement on the last day of last year, where Manulife REIT says that they have written down, or they were asked by the valuers to write down almost 237 billion. Yes, ladies and gentlemen, 237 billion is almost a quarter of a billion. This is by far one of the sharpest write-down ever in the history of Singapore real estate investment trust of the last 21 years. Well, and what was the excuse given again? Look further, the round one that's actually encircled there. They say the decline in valuations due to higher discount rate and capitalization rate due to continued weakening of occupational performance of the submarkets. Take a step back, ladies and gentlemen. Think. Higher cap rates, higher occupancy rate, continued weakening of the submarkets. I thought if you have a good manager of this real estate, you could have foreseen this, right? So why up to close to the last year, they were still acquiring assets, into places, into domicile, and trying to actually hotelize, their assets, spend on AEI, on buildings where they don't seem to be able to capture the rental flow, and hence a big write-down, right? So it also means, ladies and gentlemen, that the acquisition they have done over the years, if we look at the write-downs, it's scary. Okay, so where do you stand? Okay, will it turn around? You be the judge. So, but if you follow us at GCP Global, you notice that over the years, other than in my book, in the last 1 year, in the last 9 months, I've warned about US office REITs being value traps. You can see it in this particular YouTube video, which was posted 9 months ago. And then 8 months ago, we talked about the crash of digital core REIT. If you look at my video last week, this is something I continue to expound upon. Okay, and as we end the first quarter, you notice that another REIT now has come into focus. That's Prime REIT. Man, ladies and gentlemen, it was prime for a huge fall for Prime REIT. The share price got hammered down 80 cents in the last 1 year, just 1 year, down to 30 cents as of yesterday. That's down a whopping 63%. A whopping 63%. It's rounding up one of the worst routes. Okay. Now and in my last few videos, you notice I've been noticing about and sharing with you all this underperformance, because it is for your interest, real estate investment trust shareholders, as well as our concerned and our concerns, because in Singapore stock market, other than the REITs are probably the last bastion of good investments other than banks. There are very few other companies outside these two sectors that are good for investments. And I know, having taught for the last 34 years to family funds, the old rich, the old money, the conservative investors, the retirees who come to GCP Global classes, that they want to preserve capital. The notion that REITs are able to generate state income because of quarterly or half a year dividend, plus a possibility of capital gain, plus capital forex exchange gains. If you are living in, say, Malaysia, Indonesia, Thailand in the last couple of years, that has proven right. Okay, can be shaken if this kind of REITs like your Manulife, EC World, your Prime, your Digital Core continue to see huge underperformance. It will drain the confidence from the market. And as you can see, ladies and gentlemen, confidence is a very, very subtle and fragile thing, as we've seen in the run of the banks, both in Europe and both in the US. So let's not wait until we have a run on real estate investment trusts to be aware of this kind of risk, to be aware of this huge underperformance. Now, hopefully, these are just the exception to the real estate market in Singapore. But you as an investor, you have to be aware. And if you continue to be lost, ladies and gentlemen, do join us for our class at GCP Global, where every quarterly we conduct our quarterly REITs class to guide you, handhold you, and most importantly, to forewarn you on such REITs. Okay, we also go through your portfolio allocation to make sure that you are primed to enjoy steady income, from real estate investment trusts. Okay, more so, if you look further, ladies and gentlemen, if you had been shareholders of these 4 REITs or even the top 10 losing REITs, you notice that you could possibly have missed out a few things. Now, this is the latest FOMC dot plot from the Federal Reserve. Look, I think a lot of rhetoric, a lot of literature in the market is actually trying to pinpoint when the Fed will pivot, or start to cut interest rates. And we can look from there. The Fed has indicated that there will unlikely to be any cuts this year. Of course, the market based on the 10-year bond yield and the 2-year bond yield seems to disagree. But importantly is that if you look at the yellow line, they are looking at a peak of 5.1% for this year, going down to 4.1% next year. That's 100 basis points, ladies and gentlemen, drop. Okay, so it's something, if you're a REIT investor, to be positive and excited about. And even so, another more positive thing is that if you look 2 years down the road, down to 2025, the dot plot shows that it's going to go down to 3%. That is a whopping 210 basis points drop. It's not I forecast, it is what the Federal Reserve in its latest dot plot has shown. So for you, ladies and gentlemen, to enjoy your compounding growth and compounding your wealth in real estate investment trust, right? Make sure you invest in the right REITs. So as I said, if you continue to be lost, join us for our next class on the 27th of May, so that we'll be able to guide you through and to avoid all these bad apples. Remember, ladies and gentlemen, one of my idol, Charlie Munger, has said that one of the key things about wisdom in investment management is to be able to prevent and avoid investing in rotten apples. And this is what we at GCP Global have been doing and will continue to do in the last 34 years. Till next week in our videos. Enjoy and give us a thumbs up and subscribe to our channel. And hopefully you can join us for our class.